All right, folks, let's dive into an essential part of corporate finance, working capital and liquidity management. This isn't just about balancing the books, it's about keeping the lights on, ensuring the company can meet its obligations, and making sure there's enough cash to seize opportunities when they arise. If you understand this, you're already a step ahead in navigating the financial world. So, what are we going to cover today? We'll explore short-term assets and liabilities, the cash conversion cycle, and liquidity management. Plus, we'll discuss how companies keep their operations smooth and avoid financial hiccups. Ready? Let's get started. First things first, short-term assets and liabilities. These are the things that impact a company's cash flow within a year. Think of them as the company's day-to-day lifeblood. We're talking about receivables, inventory, payables, basically anything that will turn into cash or require cash within a year. Now, here's the kicker. The behavior of these assets and liabilities depends heavily on the payment and delivery terms agreed upon with customers and suppliers. Imagine you've just made a big sale. Fantastic. But if your customer has 90 days to pay, your cash isn't exactly flowing yet. Meanwhile, your suppliers are knocking on the door expecting their money. See how it all ties together? Let's look at a quick example. Say a company sells electronics and their suppliers give them 60 days to pay for inventory, but the company offers customers 90 days to pay after purchasing. That 30-day gap is where cash flow can get tight. If they don't manage it well, they might have to borrow money or delay payments to keep things running smoothly. The operating cycle is essentially the time it takes for a company to go from cash out, buying inventory or raw materials, to cash in, collecting cash from sales. This cycle can occur multiple times throughout the year, depending on the nature of the business. To put it simply, the operating cycle includes the following key steps. Production. This is where it all begins. The company acquires raw materials and starts the process of turning them into finished products. For a manufacturing company, this could involve purchasing steel to produce cars, while for a retailer, it might mean buying clothing to sell in stores. Sales. Once production is complete, the next step is selling those products. This is the point where the company's goods hit the market and customers start buying. Collection. After the sale, the company doesn't always get its cash right away. There's often a period where the company has to wait for customers to pay. This is especially true if the company offers credit terms like net 30 or net 60, where customers have a set amount of time to pay. Purchase. Finally, after selling and collecting cash, the company goes back to the market to purchase more materials, and the cycle begins again. As you can see, because of the timing differences in cash flows, future cash inflows and outflows are recorded on the balance sheet as short-term assets and liabilities. Short-term assets. During the operating cycle, future cash inflows are recorded as short-term assets. These include receivables, inventory, and any other asset expected to be converted into cash within a year. For example, the accounts receivable from sales are recorded as short-term assets because the company expects to collect cash soon. These assets are crucial because they represent potential cash that will be available to meet the company's obligations. Short-term liabilities. Similarly, future cash outflows are recorded as short-term liabilities. These might include accounts payable for the raw materials purchased or short-term loans used to finance the production process. Short-term liabilities represent obligations that the company needs to settle within the next year, and they are critical to understanding the company's liquidity position. All right, moving on to the cash conversion cycle, CCC. This is where things start getting really interesting. The CCC is a metric that helps us understand how long it takes a company to convert its investments in inventory and other resources into cash from sales. The formula looks like this, or simply put, CCC equals the time it takes to sell inventory plus the time it takes to collect receivables minus the time the company has to pay its bills. Now let's break this down. Days of inventory on hand, DOH. This is how long the company's inventory sits on the shelves. The shorter, the better. For example, a grocery store with perishable items like fruits and vegetables would want to keep their DOH as low as possible. A high DOH might mean they're holding on to goods for too long, which could lead to spoilage or markdowns. Days Sales Outstanding, DSO. This tells us how quickly the company collects cash from customers after a sale. Again, quicker is better. For instance, a software company might have a DSO of 45 days if it allows its customers to pay within that period after delivering a service. If the DSO is too high, the company might face cash flow issues because it's not getting paid fast enough. Days Payable Outstanding, DPO. This is the flip side. How long the company can wait before paying its suppliers. Longer is better, within reason, of course. For example, a manufacturing firm might negotiate a DPO of 60 days, giving them more time to use the cash from sales before paying their suppliers. But if they stretch this too long, suppliers might lose trust or increase prices. What's the ideal scenario? A short or even negative CCC. This means the company is getting cash from customers before it needs to pay suppliers. That's cash you can reinvest in the business or use elsewhere, minimizing the need for external financing. Let's consider a real-world example, Dell Computers. They were known for their negative CCC in the early 2000s. They received payments from customers before they had to pay suppliers, allowing them to reinvest that money immediately. This efficiency was a key part of their business model. Let's talk strategies. Companies love a short CCC because it means more cash in hand faster. Here are some ways they can shorten the CCC, minimize days inventory on hand. This could mean discontinuing slow-moving products, negotiating more frequent deliveries, or using data analytics to keep inventory levels optimal. For instance, fast fashion brands like Zara use sophisticated inventory management systems to ensure they're not sitting on unsold stock. They track trends and sales data in real time to adjust production and inventory levels quickly. Accelerate days sales outstanding. Offering discounts for early payments, enforcing penalties for late payments, or tightening credit policies can help speed up collections. For example, a company might offer a 2% discount if customers pay within 10 days instead of the usual 30. This incentivizes quicker payment, bringing cash in sooner. Extend days payable outstanding. Companies might negotiate longer payment terms with suppliers, but be careful. This could come with higher costs or other strings attached. A classic example is Walmart, known for its strong negotiation skills with suppliers. They often secure extended payment terms, which helps them keep their CCC low. These strategies help improve cash flow and financial efficiency, which is exactly what we're aiming for. So where does liquidity come from? Let's break it down into primary and secondary sources. Primary sources, cash and marketable securities. This is your most immediate source of liquidity. Cash is right there, and marketable securities can be sold quickly without much loss in value. Think of these as your emergency fund. If something unexpected happens, you can access these funds almost instantly. Borrowings, loans from banks, bonds, or even suppliers can provide liquidity, but remember, this adds debt that has to be repaid. For example, a company might take out a short-term loan to cover payroll during a slow sales period. This can be a lifesaver, but it's not without cost. Cash flow from operations. This is the cash generated by the company's core business activities. It's a crucial indicator of the company's liquidity health. For instance, if a company consistently generates strong cash flow from operations, it's in a good position to meet its obligations without relying on external funding. Now, when primary sources aren't enough, companies might tap into secondary sources. These aren't as favorable, but can be necessary. Suspending or reducing dividends. This can conserve cash, but might send a signal to investors that the company is in trouble. For example, during the 2008 financial crisis, many companies cut or suspended dividends to preserve cash, signaling to the market that they were prioritizing liquidity over shareholder returns. Delaying or lowering capital investments. This can save cash short term, but could limit growth in the long run. Imagine a tech company delaying the development of a new product line to save cash. While this conserves liquidity, it might also slow down innovation and market competitiveness. Issuing equity. This raises cash but dilutes the ownership of existing shareholders. For example, a company might issue new shares during tough times to raise capital. However, this dilutes the value of existing shares, which can lead to unhappy shareholders. Selling assets, you see, this generates cash, but at the cost of potentially valuable assets. A company might sell a factory or a piece of land to raise funds quickly, but this could impact future production capacity or growth. The last resort, filing for bankruptcy, which lets the company restructure debt under court protection. This is a drastic measure and usually indicates severe financial distress, but it can give a company a chance to reorganize and survive. Let's discuss what could go wrong, drags and pulls on liquidity. These are the forces that mess with a company's ability to keep cash flowing smoothly. Drags on liquidity. These happen when cash inflows slow down. Think about uncollected receivables, obsolete inventory, or borrowing constraints. For instance, if a retailer is sitting on last season's unsold inventory, that's a drag on liquidity. They can't sell it easily, and it ties up cash that could be used elsewhere. Pulls on liquidity. These are the sudden demands on cash. Maybe the company is paying suppliers early without financial benefits, or suppliers cut credit limits. For example, if a company is suddenly required to make. All right, so how do we measure liquidity? We use liquidity ratios, which are like the vital signs of a company's financial health. These ratios help us assess whether a company can meet its short-term obligations using its readily available assets. Let's walk through the key liquidity ratios. Current ratio. This is the most basic measure of liquidity, calculated using this formula. A current ratio greater than 1 indicates that the company has more current assets than liabilities, meaning it should be able to cover its short-term obligations. For example, if a company has $1.5 million in current assets and $1 million in current liabilities, its current ratio would be 1.5. This suggests the company is in a relatively healthy liquidity position. Quick ratio, also called acid test ratio. This is a more stringent measure of liquidity. It excludes inventory from current assets because inventory is generally less liquid than cash or marketable securities. A quick ratio greater than 1 suggests that the company can meet its short-term obligations without relying on the sale of inventory. Cash ratio. This is the most conservative liquidity measure. It's calculated using this formula. A cash ratio of 1 or above indicates that the company can meet all of its short-term obligations without having to sell inventory or collect receivables. Higher liquidity ratios generally indicate a stronger financial position and a greater ability to meet short-term obligations. However, it's important to benchmark a company's liquidity ratios against industry standards and its own historical performance to assess its relative liquidity position. A high current ratio might be reassuring, but if it's significantly above industry norms, it could mean the company isn't using its assets efficiently. Let's consider an example. If company A has a current ratio of 2.5, but the industry average is 1.5, this might indicate that company A is holding too much idle cash or inventory that could be better used elsewhere. Let's break down the 3 common approaches to working capital management. Conservative approach: higher levels of current assets relative to sales, greater reliance on long-term funding. This approach provides stability and flexibility, reducing the risk of not being able to meet obligations. It's like having a big safety net. However, this stability comes at a cost. Long-term debt and equity tend to be more expensive, and you might be tying up capital that could be earning higher returns elsewhere. For example, a utility company might adopt a conservative approach, holding large cash reserves and relying on long-term debt to ensure it can meet its obligations even during economic downturns. Aggressive approach: lower levels of current assets relative to sales, more reliance on short-term liabilities. This approach reduces financing costs and operational restrictions. It's like operating with a lean, mean machine. But it comes with greater risk. There's a higher chance of cash flow problems during market stress, and the company is more exposed to interest rate fluctuations. A tech startup with fast revenue growth might use an aggressive approach, minimizing its cash reserves and using short-term financing to fuel rapid expansion. Moderate, matched approach: a balance between permanent asset needs funded by long-term sources and variable needs funded by short-term sources. This approach offers lower costs than the conservative approach while reducing the risks associated with the aggressive approach. However, there might be limits to short-term capital access and uncertainty around costs during market disruptions. A mid-sized manufacturing company might use a moderate approach, balancing its need for flexibility with the stability required to manage seasonal fluctuations in cash flow. Credit policies also play a crucial role in working capital management. Offering more generous credit terms can boost sales, but it also increases accounts receivable and the risk of payment delinquencies, which could require additional financing. For example, if a company extends its credit terms from 30 days to 60 days to attract more customers, it might need to borrow more to cover the cash gap. Finally, let's talk about short-term financing. This is an essential aspect of financial management that enables companies to meet their short-term obligations, such as paying suppliers and employees. Effective short-term financing strategies help businesses maintain financial flexibility, accommodate fluctuating cash needs, and optimize borrowing costs. Key objectives of short-term financing: ensuring access to diverse credit sources. A company should have multiple sources of credit to meet its cash needs and reduce dependency on any single lender. This might include bank loans, commercial paper, or lines of credit. Securing enough funding capacity: companies need to ensure they have enough funding capacity to handle varying cash demands including seasonal peaks or periods of rapid growth. For instance, a retailer might secure additional financing before the holiday season to stock up on inventory. Ensuring competitive financing rates and terms, understanding how these rates may shift with capital market changes is crucial. Companies should aim for the best possible rates to minimize borrowing costs. Considering all funding costs, it's important to account for both implicit and explicit costs to ascertain the effective borrowing cost. For example, a loan might have a low interest rate, but if it comes with hefty fees, the overall cost could be higher than anticipated. Factors influencing a firm's short-term funding approach. The size of the company determines the range of available financing options. Larger firms typically have more access to diverse sources like short-term fixed income markets, whereas smaller companies might rely on single bank credit lines. A company's creditworthiness affects loan approval, interest rates, and potential operational restrictions imposed by lenders. For example, a company with a high credit rating might secure a loan at a lower interest rate compared to a company with a lower credit rating. Firms operating in markets with less developed legal frameworks might depend more on trade credits due to limited financing options. This could be the case in emerging markets where access to traditional financing is more challenging. Certain regulated industries, like financial institutions, may face borrowing limits or have unique funding sources, such as access to central banks. For example, banks might have different regulatory requirements that affect their liquidity management strategies. The nature of a firm's assets can make them suitable as collateral for secured funding. For instance, a company with valuable real estate might use it as collateral to secure a short-term loan at favorable terms. So there you have it, a comprehensive overview of working capital and liquidity management. This isn't just a set of concepts to memorize for the CFA exam. It's a practical guide to how businesses stay solvent, manage risks, and seize opportunities. Understanding and applying these principles is critical, not just for passing the CFA exam, but for excelling in the world of finance. Now take this knowledge, apply it to the practice problems, and you'll be well on your way to mastering the financial game. Thank you for your attention, and good luck with your studies.